In June 2026, something happened that would have been unthinkable just 20 years ago. A single investment fund crossed the $1 trillion mark. Not a country's GDP, not a tech giant's market cap. An exchange-traded fund. The Vanguard S&P 500 ETF, ticker VOO, became the first ETF in history to hold more than $1 trillion in assets under management. And here's what makes that number truly staggering. Roughly 1 out of every $10 flowing into ETFs right now is going into this one fund. That's not just a milestone, that's a signal. The passive investing revolution has reached an inflection point, and whether you're already invested or still sitting on the sidelines, this changes the game for everyone. So how did we get here? The Vanguard S&P 500 ETF launched in 2010, and for its first few years, it grew steadily but quietly. Then something shifted. After the 2008 financial crisis, investors started asking hard questions about what they were actually paying for. The average actively managed mutual fund charged around 1% of assets per year in fees. VOO charged 0.03%. That's 0.03%. Over time, that difference compounds into life-changing money. Let me show you what I mean. $100,000 invested for 30 years at 8% annual returns with a 1% fee grows to about $760,000. With a 0.03% fee, that same investment grows to just over $960,000. The fee difference alone costs you $200,000. That's not a small gap. That's the difference between a comfortable retirement and a tight one. And that's the math that drove the passive revolution. The numbers behind this shift are staggering. The global ETF industry now sits at over $23 trillion in assets. In the United States alone, ETF assets have reached $15.7 trillion. And the pace is accelerating. In the first 5 months of 2026, global ETF inflows hit $1.07 trillion, the strongest start to any year on record. To put that in perspective, the previous record for the same period was $738 billion, set just last year. We're not just seeing growth. We're seeing a structural shift in how the entire world invests. Every major financial institution, every pension fund, every retail investor platform is moving in the same direction. The question is no longer whether you should own index funds. The question is why you wouldn't. Let's talk about what makes VOO specifically so dominant. The fund tracks the S&P 500, which means it holds roughly 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Nvidia, Amazon, Meta, the companies driving the AI revolution and the broader economy. Over the past 10 years, VOO has delivered an average annual return of 15.6%. That timeframe includes the COVID crash of 2020 and the 2022 bear market, where the S&P 500 dropped more than 18%. Even with those drawdowns, the long-term return is exceptional, and the expense ratio of 0.03% means you keep almost all of it. The fund is so large and so liquid that trading spreads are virtually zero. When you buy or sell VOO, you're getting the market price with almost no friction. That combination of low cost, broad diversification and liquidity is why VOO has attracted more than $400 billion in net inflows over the past 3 years alone. That's more than double the next closest fund, the iShares Core S&P 500 ETF, which has taken in around $176 billion. But here's where it gets interesting. While VOO and its peers have been breaking records, something unexpected has been happening alongside them. Active ETFs, funds where managers pick stocks rather than tracking an index, have been growing even faster than the overall market. In the first quarter of 2026, active ETF inflows hit $245 billion, a 70% increase over the previous record. Year to date, active ETFs have gathered over $400 billion, almost double what they collected in the same period last year. So what's going on? Are investors abandoning index funds? The answer is no. What we're seeing is a market that's maturing. The core of most portfolios remains passive index funds, VOO, IVV, VTI, the big broad market ETFs. But around that core, investors are adding active ETFs for specific purposes. Think of it like building a house. The foundation is your index fund. The rooms and finishing touches are the active strategies. The foundation is bigger than ever, but people are also adding more rooms. The Vanguard S&P 500 ETF alone has taken in over $400 billion in net inflows over the past 3 years. That's more than double the next closest fund. The passive core isn't shrinking, it's growing faster than ever. The active ETF growth is additive, not competitive. It's investors saying, I have my core index holdings, and now I want to add some targeted exposure to AI infrastructure or emerging markets, or a specific sector. The index fund remains the anchor. So what does this mean for you, the average investor? 3 things. First, the case for low-cost index funds has never been stronger. When a single fund reaches $1 trillion in assets, it's not a fad. It's a structural shift validated by millions of investors making rational choices. The expense ratio of 0.03% means you keep almost everything the market gives you. Second, don't let the rise of active ETFs confuse the picture. Active management has its place, but the data is clear. Over the long term, the vast majority of active managers fail to beat their benchmark. The SPIVA scorecard from S&P Dow Jones Indices has shown this year after year. Over a 15-year horizon, more than 90% of actively managed large-cap funds underperform the S&P 500. The ones that beat the market in any given year are rarely the same ones that beat it the next year. Trying to pick the winning active manager is a game with terrible odds. Third, the most important investment decision you'll make isn't which fund to pick. It's how much you save and how long you stay invested. VOO's journey to $1 trillion wasn't built on brilliant stock picks. It was built on millions of people consistently putting money into a low-cost fund and leaving it alone. The discipline to keep investing during bear markets, to ignore the noise, to let compounding do its work. That's what separates successful investors from the rest. The S&P 500 is currently trading around 7,500 points, up more than 11% year to date. The market has had a remarkable run. But here's the thing about index investing. You don't need to predict where the market is going next. You just need to be in it. The $1 trillion milestone for VOO isn't just a number. It's proof that the simplest strategy often wins. Low costs, broad diversification, long time horizons. That's the formula. It's been working for decades. And it's not going to stop now. Let me leave you with one final thought. The global ETF industry has grown from essentially nothing in the early 1990s to over $23 trillion today. That's a compound annual growth rate that would make any investor jealous. And the trend is accelerating. In 2024, global ETF inflows were $594 billion. In 2025, they hit $738 billion. In the first 5 months of 2026 alone, we've already crossed $1 trillion. At this pace, the industry could see $2 trillion in inflows for the full year. That's not just growth. That's a revolution in how the world invests. And the beauty of it is that you don't need to be a Wall Street professional to participate. You don't need a finance degree. You don't need to watch the markets every day. You just need to buy the index, keep buying it consistently, and give it time. Here's what I want you to take away from this episode. The passive investing revolution isn't slowing down, it's accelerating. $23 trillion in global ETF assets, $1 trillion in a single fund. Record inflows year after year. The market is voting with its money, and the message is clear. Index funds work. Whether you're just starting your investment journey or you've been at it for years, the principles are the same. Keep your costs low. Stay diversified, and give your investments time to compound. The $1 trillion ETF isn't the finish line. It's just the beginning. Thanks for watching Wealth Unlocked. If you found this helpful, hit subscribe and turn on notifications. The best investment you can make is in your own financial education, and we're here to help every step of the way. See you in the next one.